Stop overpaying your property taxes. There are senior tax relief programs your county has never told you about. If you own your home and you are over the age of 60, stop what you are doing right now and grab your most recent property tax bill. Keep it close for the next few minutes because there is a very real chance you are legally overpaying by hundreds, sometimes thousands of dollars every single year, and no one at any government office is going to call and tell you that. The county does not reach out when you turn 65. The tax assessor does not send you a notice. The forms that could save you over $1,000 a year are sitting on a government website that most homeowners have never visited. And the deadlines pass quietly every January, every February, every April, while those savings disappear permanently into the county's general fund. These programs exist. They are funded. They are available right now. The only reason most senior homeowners never benefit from them is that the system requires you to find them yourself, apply yourself, and meet every deadline yourself, or you receive nothing. That is the uncomfortable reality of how these programs are structured. They are not advertised. There is no outreach campaign. There is no mailer that shows up explaining your options. The money sits there waiting, and the only people who collect it are the ones who knew to go looking. By the time this video ends, you are going to know the 4 major categories of senior property tax relief that exist in nearly every state in America. You are going to know the age and income thresholds that qualify you. You are going to know the 3 mistakes that cause eligible seniors to lose benefits they are fully entitled to, and you are going to have a clear step-by-step process to act on this before the next deadline passes. Pull that tax bill a little closer. Here is a financial reality that most retirement content completely ignores. Property taxes are not based on what you paid for your home. They are not locked in at the number on your original purchase contract. They are recalculated based on what your county assessor decides your home is worth right now, using current market comparisons in your area. And over the past decade, home values across most of the country have risen sharply in many markets. That means property tax assessments have been climbing alongside them, often at a pace that outpaces inflation, outpaces Social Security cost of living adjustments, and outpaces the fixed income that millions of retired Americans are living on. Think about what that means in practical terms. You retired, you paid off the mortgage or came close to it. You planned carefully for decades. You made the sacrifices, put money away, avoided unnecessary debt, and built the kind of stability that most financial advisors spend their careers telling people to aim for. And now, every year, a bill arrives in your mailbox that is larger than last year's. You did not earn more money. Your house did not get bigger. You did not ask for any of this. The county simply decided your home is worth more and sent you the math. For a senior living on Social Security, a pension, and modest savings, this is one of the most damaging and least discussed financial pressures in retirement. It does not make headlines. It does not get talked about at the dinner table the same way healthcare costs do. It just quietly drains retirement accounts, forces difficult financial decisions, and pushes people out of neighborhoods they have lived in for 30 and 40 years, neighbors they have known for decades, communities they helped build. The good news is that lawmakers in nearly every state have built specific legal relief programs for older homeowners in direct response to this problem. These programs are not loopholes. They are not workarounds. They are legitimate, government-funded relief mechanisms that were specifically created to protect senior homeowners from being priced out of their own homes by rising assessments. Let us go through all 4 in detail. The first is the Senior Homestead Exemption. This is the most widely available form of senior property tax relief in the country. A homestead exemption reduces the taxable assessed value of your primary residence by a fixed dollar amount or percentage before your tax rate is applied. For senior homeowners, this exemption is designed to be larger than the standard exemption available to everyone else because the state recognizes that older residents on fixed incomes need more meaningful protection than working-age families who have additional earning capacity to absorb rising costs. Depending on your state, county, and sometimes your municipality, A senior homestead exemption can reduce your home's taxable value by anywhere from a few $1,000s on the low end to $50,000 or more in states with generous programs. When you multiply that reduction by your local tax rate, the annual savings can reach hundreds or even thousands of dollars. To make the math concrete, if your home is assessed at $300,000 and your local tax rate is 1.2%, your bill before any exemption is $3,600 a year. Apply a $25,000 senior homestead exemption, and the taxable value drops to $275,000. Your new bill is $3,300. That is $300 saved every single year from one application filed one time. In states with higher exemptions or higher tax rates, annual savings can reach $800, $1,200, or more. And remember, this is just one of 4 programs. Many seniors qualify for multiple programs simultaneously, and the combined savings can be significantly higher. Most programs require you to be 65, though some begin at 62 and a handful allow it starting at 60. The home must be your primary residence, meaning the address where you actually live, not a vacation property or a rental. And in most states, this is a one-time application. Once approved, the exemption renews automatically every year for as long as you remain in the home and continue to meet the basic criteria. You file once and the savings follow you for the rest of your time in that home. What makes this program particularly important is how often it goes unclaimed. County assessor offices across the country consistently report that a significant portion of eligible senior homeowners have never applied, not because they do not qualify, not because the program is difficult to access, simply because nobody told them it existed. That changes today. The second program is the Senior Property Tax Freeze. If the homestead exemption is the most common program, the freeze is the most powerful one that most seniors have genuinely never heard of. A tax freeze locks the assessed value of your home at whatever level it was when you first qualified, regardless of how much your home's market value increases in the years that follow. If you qualify for a freeze this year with your home assessed at $280,000 and your home's value climbs to $420,000 over the next 12 years, you are still paying taxes on $280,000. The county does not get to collect on appreciation you never cashed out, equity you never touched, a gain that exists only on paper until the day you sell. States that offer some version of a senior property tax freeze or assessment cap include Illinois, New Jersey, Texas, Oklahoma, Tennessee, South Carolina, and several others. The specific mechanics vary by state. Some freeze the assessed value directly. Others cap the annual percentage increase at a very low number, effectively achieving the same outcome over time. Most programs set an annual income ceiling somewhere between $30,000 and $65,000, depending on the state and sometimes the county. Income calculations typically include Social Security benefits, pension distributions, and IRA withdrawals. Some states exclude certain medical expenses or disability payments from the calculation, which can be meaningful for seniors who are right at the edge of the income limit. What makes this program worth your complete attention is how the benefit compounds over time. If property values in your area continue rising and your bill stays frozen while your neighbors watch theirs climb every single year, the cumulative savings over a 15 or 20-year retirement can be genuinely significant. This is not a hypothetical, it is arithmetic, and it works entirely in your favor once you are enrolled. The third program is the property tax deferral. This one is designed for a situation that is extremely common among older homeowners. You own a home worth a meaningful amount, but your monthly cash flow is tight. After groceries, utilities, insurance, and medical costs, there is very little left. The property tax bill creates real financial stress, even though, on paper, you have substantial equity in the home around you. This is a reality that millions of senior homeowners live with every single day, and the deferral program exists specifically to address it. A deferral program allows qualifying senior homeowners to delay paying some or all of their property tax bill until the home is eventually sold or until the homeowner passes away. The unpaid taxes accumulate as a lien against the property, typically at a low state set interest rate that is well below what you would pay on a personal loan or a credit line. When the property changes hands, the accumulated balance is paid from the sale proceeds. You stay in your home, you keep your equity, you eliminate the immediate payment pressure. States with deferral programs include Oregon, Washington, Colorado, California, Massachusetts, and many others. The income limits for deferral programs tend to be more generous than freeze programs because the state is not foregoing the tax revenue permanently. It is simply adjusting when it collects. That flexibility allows more seniors to qualify. If you have been thinking about a reverse mortgage, or if you have even considered selling your home simply to manage monthly expenses during retirement, look into your state's deferral program before making any of those decisions. The deferral is almost always a far less costly and less disruptive option, and it preserves the equity you have spent decades building. The fourth program is the Circuit Breaker Tax Credit. The name comes from the electrical device that shuts off a circuit when the load becomes dangerous. Applied to property taxes, the concept works the same way. When your tax burden becomes disproportionately heavy relative to your income, the credit activates and returns money directly to you. A circuit breaker credit provides relief when your property tax bill exceeds a certain percentage of your total annual income. The exact trigger percentage varies by state, but the principle is the same across all of them. If taxes are consuming too large a share of what you bring in each year, you receive a credit to bring the effective burden back into proportion. Many states offer enhanced circuit breaker benefits specifically for seniors, recognizing that fixed retirement income means the overload threshold arrives far sooner for older households than for working age families with growing incomes. This credit is typically claimed on your state income tax return rather than through a separate county application. That means if you are eligible but have not been claiming it, you may be able to file amended state returns for prior years and recover credits you were entitled to but never received. Depending on how many years back your state allows amendments, this could mean recovering multiple years of credits in a single filing. Annual amounts range from a few $100s on the lower end to over $1,000 in more generous programs. Now, the three mistakes that cause eligible seniors to lose benefits they fully qualify for. Understanding these is just as important as understanding the programs themselves, because you can qualify completely and still walk away with nothing if you fall into any of these traps. The first is missing the application deadline. Every senior property tax program operates on a fixed annual deadline. Most fall somewhere between January and April, though some states have deadlines as late as June or September. There are no extensions granted for seniors who discovered the program too late, forgot to file, or experienced a health issue during the application window. If you miss the deadline, the savings for that tax year are gone permanently. You cannot recover them retroactively in most programs. That money is simply lost. The solution is straightforward, but requires you to act on it today, not eventually. The moment you identify which programs you qualify for in your state, write the application deadline on a physical calendar, set a recurring reminder on your phone, and tell a trusted family member or friend so there is a second person tracking it. Give yourself at least 3 weeks before the actual deadline to gather your documents and complete the application without rushing. One date written down today is the entire difference between receiving the benefit every year and losing it every year. The second mistake is failing to report changes in ownership or marital status. This catches seniors completely off guard because it feels counterintuitive. You have already been approved, the exemption is showing on your account, the savings are appearing on your annual tax bill, everything seems automatic and stable. Then something changes in your life. A spouse passes away and the property title transitions into your name alone. You add a family member to the deed as part of an estate planning strategy. The property is retitled following a mortgage refinance or a trust arrangement. These events, which feel like entirely private family or financial matters, can quietly and automatically cancel your senior property tax exemption with no notice from the county whatsoever. Many states require the exemption to be held in the name of the qualifying individual. When the ownership record changes in the county system, the exemption may be dropped from the account. The next tax bill arrives without it applied, often many months after the ownership change occurred, and the difference can be hundreds of dollars you were not expecting to owe, with a deadline attached. If anything has changed about who appears on your home's title in the last 2 years, call your county assessor's office this week. Not this month, this week. Ask them to confirm that your senior exemption is still active and properly recorded on your account. That call takes about 10 minutes and can catch a problem before it becomes an unexpected bill. The third mistake is ignoring the annual income verification requirement. Freeze programs, deferral programs, and many enhanced exemption programs require you to confirm your income eligibility every single year. The county sends a verification form. You complete it, attach required documentation such as a Social Security benefit statement or a copy of your most recent tax return, and return it by a specified date. The problem is that these forms frequently arrive in envelopes that look completely ordinary. No bold warning on the outside, no urgent language, nothing that signals this particular piece of mail is standing between you and over $1,000 in annual savings. Many people set them aside thinking they look like standard informational mail. The deadline passes, the benefit is suspended, and the only way to find out is when the next tax bill arrives and the savings are gone. Starting today, make a firm household rule. Every piece of mail that arrives from your county tax assessor's office, your county revenue department, or your state department of taxation gets open the same day it arrives. Not the next morning, not after the weekend, the day it arrives. If it is a verification form with a deadline, complete it within 48 hours and return it with delivery tracking. This single habit, applied consistently, protects every benefit you have earned from disappearing quietly in a stack of unopened mail. Here is your step-by-step action plan to go from knowing about these programs to actually being enrolled in them. Step 1. Identify the specific programs available in your state. Go to your state's Department of Revenue or Department of Taxation website and search for the phrase Senior Property Tax Exemption followed by your state's name. Every state maintains a dedicated page describing available programs, income thresholds, age requirements, and application deadlines. If navigating the website is difficult, call your county assessor's office directly. Give them your age and ask them to walk you through every senior property tax program you might qualify for in your county. Ask them to mail you the application forms. Write down every program name and every deadline they give you. If the person you speak with is not helpful, call back and ask to speak with a supervisor. You are entitled to this information and it is their job to provide it. Step 2. Gather your documents before you need them. Nearly every program requires the same basic set of paperwork, and having it all ready before you begin the application means you can complete everything in a single sitting rather than over multiple weeks of tracking things down. You will need proof of age, which is a driver's license, state ID, or birth certificate. You will need proof of primary residency, which is your current property tax bill, or a utility bill in your name at the property address. You will need proof of income, which is your most recent federal tax return, your Social Security benefit verification letter, your pension award letter, or any combination of documents that establishes your total annual income. And you will need proof of ownership, which is your recorded deed or a current mortgage statement showing your name on the property. Put all of these in a single folder right now and label it clearly. When the application is in front of you, you want to move quickly and confidently. Step 3, apply and maintain a complete paper trail. Most county assessor offices accept applications by mail, in person at the county government building, or through an online portal. Whichever method you choose, document every step. If you apply by mail, use certified mail with return receipt so you have a legally dated record of delivery. If you apply online, take a screenshot of the confirmation page and save the confirmation number somewhere you can find it. If you apply in person, ask the clerk to date stamp your copy of the application before you leave. If your application is ever denied, your documentation is what makes an appeal possible and credible. Keep these records permanently, not just until you hear back. Step 4. Set a recurring annual reminder. Set a reminder on the same date every year, approximately 45 days before your application or renewal deadline. Label it clearly with something like Senior Property Tax Exemption Renewal, check mail from county, submit income verification. This one repeating reminder set once today protects every dollar of relief you qualify for from slipping away because of a missed form or a deadline that crept up quietly. Step 5. Review your property tax assessment annually. Even if you are fully enrolled in every program you qualify for, it is worth reviewing your assessment each year when the notice arrives. Assessment errors happen. Clerical mistakes occur. Properties are sometimes assessed using incorrect square footage, incorrect lot size, or outdated information. If your assessed value seems significantly higher than comparable homes in your neighborhood, you have the right to appeal the assessment. Many homeowners who challenge their assessments successfully receive reductions, and the process is generally straightforward. Your county assessor's office can explain the appeal timeline and the documentation required. This is not confrontational. It is simply using the system the way it was designed to be used. Property taxes are one of the very few expenses in retirement that increase automatically and continuously, regardless of how carefully you manage everything else. You can pay off the mortgage, reduce your lifestyle spending, drive the same car for 15 years, cut subscriptions, and that property tax bill still arrives every year, larger than before, with a hard deadline and penalties for late payment. You cannot negotiate it down by spending less. You cannot avoid it by being frugal. It simply grows year after year unless you take deliberate action to limit it through the programs that already exist for exactly this purpose. The programs covered in this video exist specifically because lawmakers at the state level recognize that fixed income retirees cannot indefinitely absorb rising assessments on homes they have owned for decades. The programs are funded, the savings are real, but the design of the system places the entire responsibility of discovery, application, and annual compliance squarely on the individual homeowner. Seniors who go looking receive the benefits. Seniors who wait to be contacted never hear from anyone. You now know where to look, what to ask for, which mistakes to avoid, and which deadlines to protect. The next step belongs to you, and the right time to take it is today. Not next month when things slow down, not after the holidays. Today, while this information is fresh and the deadline is still ahead of you. If you know a Senior Support USA homeowner who has been in the same house for years and has never looked into any of this, share this video with them. Your neighbor who has lived on the same street for 35 years, your sibling who keeps saying they will look into it someday, your friend who mentioned being stressed about the tax bill that arrived last month. One conversation, started by sharing this video, could put real money back in someone's hands every single year for the rest of their retirement. That is worth 2 minutes of your time right now. Take care of yourself, take care of your money, and take action on this today before another deadline passes without your name on the application.